Long and short hedging. Hedging is a financial strategy used to reduce the risk of adverse price movements in an asset. There are two primary types of hedging. Long and short hedging are two fundamental strategies in the hedging landscape. Long hedging involves taking a long position in a derivative to protect against potential price increases in an asset. Conversely, short hedging involves taking a short position to guard against potential price declines. Both strategies are essential for managing risks associated with fluctuating market conditions. Hedging instruments include a variety of financial products such as futures, options, swaps, and forward contracts. Each instrument has unique features and is suitable for different hedging scenarios. Long hedging is a strategy used to protect against the risk of rising prices. It involves buying a futures contract or an option to lock in the current price, ensuring that the buyer can purchase the asset at a predetermined rate in the future. Long hedging is commonly used in markets where price volatility is a concern. For instance, commodity producers like farmers use long hedging to secure favorable prices for their products. Similarly, businesses relying on raw materials hedge against price increases to stabilize production costs. Futures contracts are standardized agreements to buy or sell an asset at a future date at a predetermined price. Long hedging with futures allows investors to lock in the purchase price, mitigating the risk of price increases. Options provide the right, but not the obligation, to buy an asset at a specific price within a certain period. Long hedging with options offers flexibility, as the buyer can choose to exercise the option if the market conditions are favorable. Example: a wheat miller who needs to buy wheat in 6 months might use a long hedge. By buying wheat futures contracts now, the miller can secure the current price. If wheat prices rise in the future, the gains from the futures contracts will offset the increased cost of buying wheat. A setup mechanism for a long hedge would consist of: 1. Buy futures contracts of the underlying asset. 2. Hold the contracts until the desired future date. 3. If prices rise, the increase in futures contract value offsets the higher cost of the asset. The primary advantage of long hedging is risk mitigation. By securing prices in advance, businesses can plan their finances better and avoid unexpected costs. Additionally, it provides a measure of stability in volatile markets. One major disadvantage of long hedging is the potential for missed opportunities. If the market price falls below the hedged price, the hedger may end up paying more than the current market rate. Furthermore, hedging involves costs such as premiums for options and margins for futures, which can add up. Short hedging is employed to protect against the risk of falling prices. It involves selling a futures contract or buying a put option to lock in a current selling price, ensuring that the seller can sell the asset at a predetermined rate in the future. Short hedging is widely used in markets with high price volatility. For example, businesses that hold large inventories of commodities use short hedging to secure current prices and safeguard against potential price drops. Selling futures contracts enables investors to lock in a selling price for an asset, protecting against potential price decreases. This strategy is particularly useful for producers who want to ensure a minimum return on their products. Buying put options provides the right to sell an asset at a specific price within a certain period. Short hedging with put options offers the flexibility to benefit from favorable market conditions while ensuring protection against price declines. Example: a farmer who expects to harvest and sell corn in 6 months might use a short hedge. By selling corn futures contracts now, the farmer can secure the current selling price. If corn prices fall in the future, the losses from selling corn at a lower price are offset by gains in the futures contracts. A setup mechanism for a short hedge would consist of: 1. Sell futures contracts of the underlying asset. 2. Hold the contracts until the desired future date. 3. If prices fall, the increase in the value of the short position offsets the lower selling price of the asset. Short hedging provides a safety net against falling prices, ensuring that businesses can maintain their revenue streams. It also allows for better financial planning and stability in volatile markets. The primary disadvantage of short hedging is the potential for opportunity loss. If the market price rises above the hedged price, the hedger may miss out on potential gains. Additionally, like long hedging, short hedging involves costs such as premiums and margins. Just a quick reminder to please destroy the like button and don't forget to subscribe to the channel to receive more content like this. Also, Visit us on the web at www.investmenttees.com and use code BLOG to receive 25% on your next purchase. The key difference between long and short hedging lies in their purpose. Long hedging protects against rising prices, while short hedging guards against falling prices. The choice between the two depends on the market outlook and the specific risks faced by the hedger. Both long and short hedging involve the use of derivatives to manage risks. They provide a mechanism to stabilize financial performance and ensure predictable outcomes in volatile markets. Choosing between long and short hedging depends on the hedger's exposure to market risks. If the risk involves potential price increases, long hedging is appropriate. Conversely, if the risk is related to potential price declines, short hedging is the suitable strategy. 1. Risk management. Both strategies are effective risk management tools but serve different purposes based on the hedger's position, buyer versus seller. 2. Market conditions. The choice between long and short hedging depends on market forecasts and the hedger's need to protect against price volatility. 3. Cost. Hedging involves transaction costs, including broker fees and margin requirements, which should be considered when implementing these strategies. 4. Timing. Proper timing of entering and exiting hedges is crucial to maximize the effectiveness of the strategy. Causes and risk factors. Market volatility. Market volatility is a significant risk factor that drives the need for hedging. Fluctuations in prices can impact profitability, making it essential to employ hedging strategies. Economic indicators. Economic indicators such as inflation, interest rates, and GDP growth influence market conditions and can create risks that necessitate hedging. Political events. Political events, including elections, policy changes, and geopolitical tensions, can lead to market uncertainties, prompting the need for hedging strategies. Seasonal trends. Seasonal trends, especially in commodities, can lead to price fluctuations. Hedging helps businesses manage these variations and maintain stable financial performance. Speculation. Speculative activities in the market can cause price movements that impact businesses and investors. Hedging provides a counterbalance to speculative risks. Basic hedging strategies involve simple techniques such as using futures or options contracts to offset potential losses. Advanced hedging strategies include complex combinations of derivatives, such as spreads, straddles, and collars, tailored to specific risk profiles. Different sectors have unique hedging needs. For example, the agriculture sector might use commodity futures, while the energy sector might use energy derivatives. Portfolio hedging involves using derivatives to manage risks associated with a portfolio of assets. This can include strategies like index hedging or sector rotation. Conclusion. Long and short hedging are essential techniques for managing financial risk in various markets. Hedging is an essential strategy for managing market risks. They provide protection against price volatility, ensuring financial stability and cost control. By understanding and applying these strategies, investors can protect themselves against adverse price movements and achieve greater financial stability. Each approach has its benefits and limitations, and the choice of strategy should be based on the specific needs and market outlook of the hedger. Thank you for watching.